Good afternoon, everyone. It's 1:30 here in the East. We'll get started here in a moment. We see the ticker continuing to tick up with folks joining us. So please give us about another minute or so. We'll make some introductions and get underway. Okay, so I'm showing 1:31 Eastern Time. Maybe we should get underway here with some introductions and get our webinar for this afternoon underway as folks continue to dial in. My name is Paul Smith. I am a Senior Vice President with the H.W. Kaufman Group. It's my pleasure this afternoon to moderate a discussion among a terrific group of panelists. Starting off, we have Bill Gatewood. He's Corporate Senior Vice President, National Personal Insurance Practice Leader for Burns & Wilcox. Bill is based in our Farmington Hills office, but I know he's on the road this week, so he's, as usual, out taking care of business with our clients and our markets. Bill, if you could just raise your hand quickly so everyone knows. Number two, we have Blaise D'Antoni. Blaise is Executive Vice President, looks after the Eastern United States for Burns & Wilcox. He's based in New Orleans. Blaise, hello to everyone. And last but not least, Rebecca Roberts. She's Regional Vice President, looks after our, I call it the Southeast, kind of Florida, Georgia for Burns & Wilcox. And we're glad to have Rebecca in today's discussion as well. So we have a big group today. We have a lot of things to talk about. It was an exciting 2023. We think it's going to be an exciting 2024. So we welcome everyone to this afternoon's call. If you do have questions, please go to the box on the right hand, should be on the right-hand side of your screen. If you could put your questions into there, we will address them, time permitting. If for some reason we can't get to your questions, we will get back to you. Either someone on today's call will get back to you, or someone from a local office will get back to you to address any questions or comments that you may have. So thank you again for your time. We look forward to the discussion this afternoon to talk about this really exciting excess and surplus lines insurance marketplace that we are in. So without further ado, I'm going to kind of jump right into things as we typically do in the beginning of each quarter as we host these conversations with clients and carriers and others as appropriate. Blaise, I'm going to start with you. So, let's just kind of hit the ground running here, right? What's the outlook for 2024 when it comes to commercial insurance with an emphasis, again, on E&S and surplus lines?
Okay, thank you, Paul. I think to look at 2024, we got to kind of look back at 2023 real quickly just to see, what got us here. And we all know that a long soft market played a major part in kind of making the dynamics of the losses that we've had beginning in 2020 from a hurricane standpoint. We had Cat 4s hit the United States coastline in 2020, 2021 for the first time in record, and the losses that were generated from that, along with all the convective storms, brush fires, and the worldwide storms that affect the worldwide insurance industry, kind of led us to the market in 2023, where we saw the reinsurance market be unpredictable, unstable. Layers were hard to put together. We saw double-digit rate increases, much lower attachment points. Many programs, including a lot of the state citizens-type programs, couldn't put together the layers they needed. And it forced many of our markets, both in the domestic E&S carriers as well as the Lloyd's market, to really lower and reduce their exposures in order to get the proper reinsurance or the affordable reinsurance that they needed. And many markets either exited the cat space or pulled way back and reduced their writings, which drove, for those staying, drove double-digit rate increases, higher deductibles, and a much stronger emphasis on underwriting, right? From construction, updates, and especially insurance to value. I think during that prolonged soft market, insurance to value was overlooked in the underwriting process, which sometimes happens in a long soft market. And with the inflation and the cost of goods, it really took its toll on the companies from a standpoint where the amount of money they got for the covered loss was not anywhere near to cover that and drove the claims amount a lot more than they predicted. And that has really brought us to where we are now. And I think, we've had a fairly quiet storm season from a loss standpoint. We did have a lot of storms, but from a loss standpoint, and while we still have convective storms and other losses, I think for the first time, we're seeing in many areas, especially in some of the Gulf Coast areas, some optimism from the market. And so I think 2024 is looking to be much more optimistic. 2023, I think we had a lot of underwriters underwriting for their jobs, and it was a very somber tone with all the cuts that had to be made. But I think the cutting is done, and I think companies are now forward-looking into writing and getting back into business. And I think those areas that have gone through a cycle where the results over the past couple of years of all the things I just talked about are viable and they're reliable with the modeling data and the company's own results, you'll see some capacity trickle back into the market. You'll see a much broader sense of optimism in the market. I don't think we're going to see a drop off in rates and deductibles and things like that at this time. I still think that there's still a lot of losses that are being paid for. The gains we've made aren't offsetting the losses that we've had in the past. But I think we're very optimistic about 2024 in the commercial sector.
Yeah, for sure. I love the way you put it. Prolonged, right, was the word that really stuck out in my mind, right? Prolonged soft market and then optimism. Those are the two kind of key words that I took out of there as we move forward. So, hey, Phil, I'm going to switch over to you now. If you were to kind of think about some of the things Blaise just said and overlay that into the personal lines sector, what would you have to say with respect to what the market outlook is for 2024?
I think it's very similar in commercial because personal and commercial share the same underlying problems. Profitability is still a challenge that all of our carrier partners and London syndicates need to overcome. And so there's been a lot of good work and a lot of hard work done over the last year to 18 months. And a lot of that work will start to impact in the coming 2024 year. There's a lot of unearned rate in the pipeline that carriers have not been able to get through various departments of insurance. And so there's a lot of pent up rate that will start to impact in 2024, which will certainly help the profitability issue. There are a lot of non-renewals that were set up in 2023. They're going to start hitting in 2024. So we're still going to see a lot of disruption in the marketplace. There's going to be rate that's going to come in. There's going to be a lot of folks that are going to be disrupted in all states due to actions that were taken by their underlying carriers. I do agree with Blaise that I don't think we'll see a lot of rate. We won't see any rate decreases. I think what we'll start to see is a little bit of stabilization where we'll have smaller increases, right? I think a lot of the terms and conditions have been baked into the programs now. The one thing that will not change, that Blaise talked about, that we'll see in personal lines too, there's not going to be any loosening up of underwriting discipline. I mean, that's going to be paramount, I think, for the coming years. And I think that when you look at the competition for capacity, and we're in competition for capacity as others are too, the thing that we keep hearing is that those who perform best will get the capacity. So whatever little bit of capacity that loosens up, it's going to go to those folks who have performed well in the past from an underwriting standpoint, from a profitability standpoint, and they'll continue to receive whatever capacity is out there. It is interesting, though, and Blaise mentioned it, there seems to be a lot more comfort with coastal capacity now than in the non-coastal areas. And that's when you get into those secondary perils of wildfire and convective storm and hail. And there's just not a lot of confidence, I think, or not as much confidence in the modeling around convective storms and wildfire as there is with hurricane. So ironically, you know, wind has always been sort of the thing that's scared everybody, and it's the thing that's caused a lot of issues for us. But we're seeing a little more comfort in those areas and not as much out west with the fire and the rest of the states with hail and tornadoes and the convective storms.
Yeah, interesting. I think we just have plenty of data, right? Historically speaking, on the coastal stuff, and we're getting better at it. Some of the convective items, wildfire items, you talk about secondary perils, if you will, they are all, we're still trying to figure that out to a degree. So sounds like we can't just look at 2024 in a vacuum. We need to really look at the history of what's been going on in the marketplace, and then certainly where we're at and how we move forward. So, hey, Rebecca, from your standpoint, and again, you look after a couple of really difficult states, right, from an E&S standpoint, right, namely Florida. Tell us about, you know, what you think it's going to look like, kind of just strictly on that southeast region, if you will.
Absolutely. Thank you, Paul. I very much agree with the comments Blaze and Bill made. I think those things are even exaggerated here in Florida. You know, we've made some really tough moves over the last couple of years as far as correcting valuation, increasing rates, re-examining the overall portfolio, and that really has helped stabilize things. The market in general has stabilized, and we believe that will continue into 2024. We are, like they said, we're also hopeful that some additional property aggregate will open up because of the corrections that have been made and the price points that are available now in the market. You know, yesterday I was speaking with Bill, and we were talking about maybe some increased mitigation efforts that would go into the overall book of business and how we can continue to use those things to improve loss results and just make our books of business more attractive. So I think we'll see more of that and just a general flattening out, and hopefully some increased capacity.
Yeah, you know, hey, we hit on a lot of things here, right? You just used the keyword mitigation. We talked about underwriting discipline. Hopefully we have enough time to get into some of these things because they're all certainly important, and I think the viewers today really need to really understand the big picture, right? You just don't look at things on an annual basis, year over year. You need to kind of look at things that, you know, how did we get to where we are, and how do we maintain that discipline moving forward? So, Blaze, you hit upon this a bit in your opening comments there, and I was hoping that you could go a little bit further on it. I think a lot of folks looked at 2023 as a relatively quiet season from a hurricane standpoint, right? Wasn't a whole lot of you know, kind of insured losses, and things were quiet, relatively speaking. But I think when you start looking at that a little bit deeper, how is that going to impact the marketplace and what our capacity is going to look like going forward here into 2024 and perhaps beyond?
I think you know, you're definitely right that from a loss standpoint, 2023 was a quiet hurricane season, but it is fourth on record for the number of hurricanes in one season. So it was an active hurricane season, which I think really stays on the mind of the insurance market, right? That the number of storms and the severity of the storms we've had over the last several years is not going to go away. You know, they're random events, and that random, all it takes is one, right, to hit and cause a lot of damage. So those things won't change, but I do think the fact that we didn't have a lot of losses from the hurricane season this year, coupled with what we've all talked about, Bill and Rebecca just talked about, the strengthening of the underwriting, right? This is you know, I've been in the industry 41 years. This was really the first time I've been through a hard market where it touched on almost every aspect of insurance, right? It was a capacity issue, which was the main issue, you know, going back to the hard market of the 80s. You know, there was a loss issue caused by the storm, so it was a rating type market, and it was also a re-underwriting hard market, and we haven't had all those factored in at one time. And I think the data points that we now collect through the the available technology, and how much and it's just on the cusp, but what artificial intelligence can now do with those data points and in the modeling will have a big impact. But I think for those areas, Louisiana is one of them that we were hitting hard in 2020, 2021. So we've had several years of verifiable results from the rate increases, from the drastic reductions in exposure by the markets, and in the underwriting, insurance to value, deductibles, and how a storm will now play out against those results. I think we've talked about this optimism that we see in 2024, and I think it brings that optimism brings capacity, because now there's more certainty, I think, by the markets, both domestic and Lloyd's, about the results that would be driven by the storms. And like Bill said, from a hurricane standpoint versus convective type storms. And so I think in those areas that have the verifiable results, and for those cover holders that have outperformed the industry or their peers, I think that's one of the big changes we'll probably see as the market creeps back in. Instead of coming in with the broad brush and treating all cover holders the same, I think the market will be much more selective in the cover holders they look to represent them. Capacity will be dealt to those who will manage it properly and drive the best business and drive the guidelines and adhere to the guidelines that the markets are looking for. So I think we're optimistic to see more capacity come back in, but like Bill said, it's going to come back in at the rates and underwriting that are in the market now. That might be a little bit of the new normal we see for markets to stay engaged in writing in cat areas. These are the deductibles we'll need. These are the rates we'll need, and you won't see that when the soft market does come back. You won't see that drop like we've seen in the past as companies fight for market share.
Yeah, stabilization.
Paul, if I could.
Sure, go ahead, Bill.
Yeah, if I could add one thing to that, I think what I've heard most from the marketplace in regards to last year's hurricane season was that the industry just dodged a bullet. I mean, there was potential if some of these storms had taken a slightly different path. Tampa is going to be completely, wiped out. So I don't think there was a sense of relief that things are changing. I think they just feel like they dodged a bullet. And I also think that this comfort level with the coastal exposure is coupled with something that Blaise just mentioned that's really important. There's a lot of people coming into the coastal marketplace now because they think the rate is finally at a point where it makes sense. If the rate was 30, 40% lower than what it is now, we'd have people still sitting out on the sidelines. So this new capacity is coming in because of where the rate levels are at now, and people feel like, okay, we're starting to get to a place where actuarially it makes sense, and we think that we can make money long term.
Right. Yeah. Hey, good point. I think we all recall kind of sitting on the edge of our seat last year and looking at the storms coming into Florida, and if it had just ticked a little bit one way or the other, would have been much more devastating and certainly a significant loss for the industry. So great points, Bill. Rebecca, what do you have to say about the 2023 hurricane season and how it might impact things going forward?
Absolutely. The one other interesting point about last year's season, the number of flood incidents that occurred here, there was a large number of uninsured situations involving flood. And I think as a local Floridian, that was really shocking to see. While the hurricanes may not have done damage, the flood and the impact that made in areas where it wasn't necessarily expected, I think that was really interesting. And I think it's changed some buying habits of consumers and the way that we want to educate people about, their flood limits and what they need to purchase and how we need to protect ourselves. That I think really stands out as a significant impact of last year's storm season. But beyond that, I think the valuation improvements And again, people understanding the need to have hardened construction on their homes and take these storms seriously, all of that really stands out.
Yeah. If I recall correctly, certainly I wasn't a Floridian, but it was a significant loss for the auto physical damage industry, right? There were, tens of thousands of vehicles lost, right? So,
right.
The typical, the Progressives of the world and the Allstates and the State Farms and so forth were just walloped when it came to the flood losses, essentially, on the auto physical damage stuff. Thanks for that perspective. I think you hit it on the nail, Bill, right? We dodged a bullet, the industry did. So fingers crossed again for this year. Bill, I'm going to stick with you and maybe just kind of changing gears a little bit on the conversation here. So having said all of those things, right, and we've been working on this for quite a while now, right, with changing rates and forms and insurance to value and all of these things kind of getting us to the point where we are now. What role do you think that the surplus lines industry is going to play in 2024 and moving forward on some of this discipline that's no longer optional, but certainly needed and required by carriers and the capital providers?
I think the surplus lines industry is going to continue to do what the surplus industry does, which is provide a little bit of supplemental help to the standard market. I think the surplus lines market had a record year in 2023. I think we'll have another record year in 2024 for a couple of reasons. There's been a lot of admitted companies that, because of the period of time that it's taken to get rate changes through the various departments of insurance, to get form changes through the departments of insurance, and as long as that's taken, a lot of admitted companies have gone to an E&S only sort of structure, or very strategically gone to an E&S structure. Some of the carriers that we work with that are exclusively wholesale have abandoned the admitted side and have gone to E&S, particularly in the liability segment. That's been such a hard line of business to make money in. So surplus lines is going to continue to grow. It's going to be a huge part of the industry. And, I know that there are probably fewer now than there were in the past, but I know there are still some agents that are a little bit hesitant about the surplus lines market, and they're worried about, the strength of the carriers that are in the surplus lines market. They think that it's an overly complex placement, but I don't think a P&C agent, particularly one that writes a lot of personal insurance, I don't think they can sit out from the surplus lines market because we've traditionally, surplus lines, I think for personal lines, has been somewhere between 5 to 10% of most agents' business. Now it's up to a third or more, and you look at states like Rebecca and Blaze that they directly manage, and it's probably over 50% of their businesses in the E&S market now. So I don't think agents can really afford to ignore surplus lines because it's going to play a huge role, particularly on the property side.
Yeah, for sure. No question about that. So, it's funny. Just yesterday, an article came out from the various stamping offices in a few of the states that are actually represented on the call here. Rebecca, for instance, in your state there, the stamping office came out and said that 2023 was over $15 billion in premium just in Florida alone last year through the stamping office, up 28%. Blaze, your next state over in Texas, similar number, not quite 15 billion last year, but close enough to round up to that, and that was up 26%. So just in those two states alone, $30 billion in premium, Bill, to your point, it can't be avoided. And then you have all of the other, surplus lines heavy states, right? California and Louisiana and so forth and so on. So Rebecca, Blaze, can you kind of fill in the blanks a little bit, freedom of rate and form? And I really think we need to talk about, Bill brought up a good point, why folks should not be reticent of the surplus lines market, right? It's a very necessary part of this marketplace that we're in right now, and why they need to lean into that with respect to finding the results for their clients. Rebecca, if you can go first on that.
Absolutely. Your point about freedom of rate and form is a great one. Because it's a non-admitted product, the carriers that are writing on non-admitted paper, they can deploy their capacity at a rate and at the terms that allow them to profitably write business in an area. And because of that, we see that the E&S sector will continue to grow in 2024 and beyond. I also think, when you think about the financial strength of the carriers that we represent, only working with A-rated carriers, that takes away some of the concern that might be out there. These are financially strong and stable companies that we interact with and trade business with. So the freedom of rate and form allows them to do, to stay relevant in an area where maybe the admitted carriers are having to leave because they cannot adjust the rate at a level that allows them to be healthy in an area.
Blaze, anything to add to that?
Yeah, no, I think especially in a hard market like this, when admitted carriers pull back, right, and profitability of certain classes drives them out of certain lines of business, the E&S market has always stepped up in those lines and from a traditional way. But I think in the market we're seeing now with just the availability of insurance in certain areas. I mean, when the state programs, the citizen programs become the largest carrier in the state, there's a concern in the market. And I think a lot of the state legislatures that in certain states that really gave the insurance industry a tough time over the several year period and caused many of these companies to stop writing, especially like we've seen out in California from a personal line standpoint. I think the pricing and affordability and the availability of insurance has really, I think, changed the outlook of states on the insurance industry. And instead of being, a necessary evil, they look at us a little bit more as a pure necessity. And we're seeing, especially like in Louisiana, we have a new insurance commissioner, and the state's working to improve the environment, to attract companies back in. Florida did an outstanding job, almost unheard of, the tort reform that happened in Florida to bring the market back in, and also, like Rebecca was talking about, flood to protect their citizens program, right? Florida is one of the only states, I think, where if you go through the state program, you have to have flood insurance. It's mandated, and that's the strength of the legislature there to protect the industry. And I think you'll see stronger tort reform in many states, and you'll see them close loopholes that protect the industry from public adjusters and from the attorneys.
Yeah, for sure. So tort reform, wow, boy, that could be used, I think, throughout all states, let alone Florida. But the other thing I think that we talked a little bit about here, and I just want to put a finer point on it, and that is that many of what we will call the admitted carriers are leaning into this E&S space themselves, and they're just using different paper, right? So I had a call earlier today with a large, traditional, household name carrier that utilizes paper or the name of their company on the E&S side that may not be familiar to most people. So, the surplus lines market is not made up of just, E&S carriers. There's many, if not all, of the major traditional global P&C insurers that have very, very vibrant areas within E&S and surplus lines and rely on us to distribute that product on their behalf. So I think it's important to know that. And then just one plug, from our perspective, I can assure any client on the webinar this afternoon, we don't work with carriers that do not meet our very strict financial standards. We go through a vetting process, whether it be through independent rating agencies or on our own, and we monitor that very, very closely. So everything that crosses our desk has been vetted, whether it's coming to you locally or through one of our practice groups, if you will. Hey, I was thinking now, we're kind of at the top of the hour here, 2:00. We spent a lot of time talking about property, first party stuff, coastal, etc. I want to put a little bit more of a bow on that and then maybe move over into a conversation surrounding some liability coverages. Bill, you hit a little bit on liability within personal. I know, Rebecca, you have some ideas about that. But before we get there, If we could maybe just talk a little bit more about insurance to value, right? Greater use of technology, AI, I think you mentioned, Blaze, right? Some of these kind of new tools that we're using to ultimately, get a quality submission to our client, to our carriers, to ultimately get the best quote for our clients. So I'm just going to throw it out there as a jump ball for any one of the three of you to talk about some of those very specific tools that we use on the property side of the house, whether it be personal or commercial.
What immediately comes to mind are some of the valuation tools and some of the tools used for crime scoring, and how important those two tools are in the underwriting process. And that will dramatically change the outcome. The valuation of a property will dramatically change the outcome of the submittal when we approach a carrier, and is it properly insured? And the crime score just tells, it tells a story about the exposure. So those are two items that immediately come to mind. Topics you mentioned.
All right.
I also think our capability to deliver real-time data to the companies, through technology, that they're getting the information immediately and in real time, and not waiting for bordereaux or for everything to be booked and issued, it will really help them feel comfort in the data points that they're collecting, and be able to monitor that information firsthand, and not after a claim. And I think it once again, it brings back the comfort level for the carriers with their partners, with the partners that have the technology and have the capabilities to do this is really important. And that for us to deal with clients that that can provide us with that data, and that data is accurate and verifiable.
Yeah, for sure.
And I would say on the insurance to value front, Paul, carriers are not going to let up on insurance to value. I think there's been a lot of catch up in the last 2 years. Inflation increases have been pretty heavy based on cost of goods. We are starting to see those annual inflation increases leveling off and coming down a little bit. But I think, at least on the personal line side, I think agents should prepare themselves and talk with their clients that the valuation of property isn't going to be a huge negotiating point. There's an amount of money that the carriers believe is going to cost to rebuild the house, and that's what insurance is for. And they have these third-party tools that they're using, coming up with valuations, and so we've seen a real slowdown in the ability to go back and forth and negotiate what we're going to insure a house for these days. Carriers are using the same data that's out there, and they're saying this is the minimum amount that we're going to insure the property for, take it or leave it.
Yeah.
And so I think that opens up a lot of opportunity for our retail partners to have conversations with their clients about what's going on in the marketplace. Insurance to value has never been something that clients have really understood or agreed with. They confuse it with, what they can sell their house for or what their mortgage amount is. They don't really understand what the valuation on their insurance policy is and how it differs. So all those things are going to remain very tight. We're not going to go back to the days of playing with a valuation to get the premium where we want it to be, or, let the customer decide, what they think their house is worth. Carriers are making those decisions now.
Yeah, hey, we talked about the ability to have all of this information and data at our fingertips now, right? We're not looking at it on a bordereau basis after the fact. We're looking at it in real time. So when we do that, carriers are looking at the same thing we are. I would suspect here, and Blaze and Rebecca, I leave it for you, but I would suspect what Bill just said on the personal line side holds completely true on the commercial side too, with building valuation, correct?
It absolutely does. Yeah, and when you just think about it in the broader scope of increased cost of materials and all of that going into the reconstruction of a property when it's damaged, it's a complicated scenario to come up with the valuation of a property. And I believe these tools that are being used dramatically assist with that. And you're right, it's very different than what the resale value of a property is. Absolutely applies in the commercial line space.
And we definitely, I mean, for those carriers willing to be in a market and to provide capacity and the capability to write in that market, they're dictating the terms. I mean, in many cases, actual cash valuation of a building is no longer an option. Everything has to be written on replacement cost. And it's a take it or leave it type scenario in this market.
Yeah, sure. Heard it here, and I'm sure that we'll continue to work with our clients to make sure that we have appropriate insurance to values. We've been talking about it candidly now for 18 months or so, but it's not going away is what we're trying to, I think the point that we're trying to get across here. Hey, so if we can switch gears now, maybe talk a little bit more about liability. It's interesting. I'm a liability guy by background, and when you mentioned tort reform, I always think that that's a liability thing, but you're so right, with respect to all of the stuff that happened in Florida, right, with the changes that took place there and how tort reform really changed that marketplace. And as I think you said, Blaze, really to help kind of citizens. But Rebecca, you kind of look after all lines of business, right, within your Southeast region there. What are the liability kind of hot buttons these days or hot spots these days that our viewers need to be mindful of?
So the HAB market, you walk into any underwriting floor and mention HAB, and you get all kinds of comments back. The product is still available, but it varies dramatically based on location, the distance to coast, the crime scores, the age of construction, loss results, all of those things. So anything in that HAB space, condos, apartments, dwelling schedules, all of that is very difficult, and we expect it will continue to be difficult. When I think about convenience stores, gas stations, any kind of lessor's risk type exposure, the assault and battery exposure is pretty significant. We've seen increased crime in areas, and all of that really impacts the liability exposure, not only for the leasee, the individual leasing that building, but also the lessor. If there's a significant incident that happens and it exceeds the available limits of the tenant, it often will fall on the actual lessor to make up the difference there. So we're seeing them get drawn into claim scenarios where they may not necessarily be at fault. Beyond that, daycares, we've seen some dramatic changes in the daycare space and availability of products, whether we're talking about home daycares or otherwise. And a lot of that has to do with the claim frequency that can occur there with children getting injured, and maybe they aren't severe injuries, but they are injuries, and a likeliness for the carrier to settle. And there's a severity problem there. So, and in the professional liability space, when you're talking about large, complex risks, we used to be able to secure that all under one underlying policy. Now we can still secure the coverage, but we're finding we're having to layer more than we did in the past to get those complex risks placed. So that's been an interesting development, and we expect that to continue. In the auto space, it's kind of different in that we've had Demotech enter the auto market, and oddly have driven prices down a bit. Some of them, the prices are a little startling and don't maybe necessarily match what we thought the price should be, and we're expecting some trending in those losses. But you couple that with a change in consumers' overall buying habits, and just the pressures in the logistics space and the cost of fuel, there's been some real struggles in 2023 in the auto placements, and we expect that to continue at least the first half of 2024.
Sure. All difficult items, and I don't think that they're specific to Florida and the Southeast, Rebecca, right? Have convenience stores, daycare, assault and battery, that's all stuff throughout the entire country. So for sure. Bill, you mentioned a little earlier about, I think, some of the liability challenges going on in the personal line space. You want to chat about that a bit?
Sure. I think all you have to look at is I think most folks in the insurance industry have heard the term nuclear verdict. That's not just a made-up term. It really it refers to jury verdicts of $10 million or more, or nuclear verdicts. And if you look at the number of nuclear verdicts that have occurred over the last 5 years and the percentage of increase, it's astronomical. And so when you start looking at the potential of a nuclear verdict where you're going to pay $10 million, whether you feel your, policy was set to cover that or not, and it goes into a jury, and juries are becoming more and more plaintiff favorable, it's cut down the number of people in the personal lines market that want to write liability. It's cut down the number of people that want to write high limits of liability. So that's been the challenge. We have a lot. A lot of people don't believe me, but it wasn't that long ago that I could get someone $100 million umbrella in an hour. And now we're very fortunate if we can find someone $10 million of coverage. So it's become tight like everything else. It's a very difficult market for people to get into if you're not in the liability space. It's very capital intensive. It has a long tail. So it's not something that people can kind of jump in and jump out of. So I think we'll see a continued tightening on the liability side, particularly in those limits that are 10 million and above. Building a tower for individuals and families will be a challenge still.
Got it. Okay. We have about 3 minutes left. So, I always like to end with hints, tips, suggestions, things along those lines there that we might have for the participants. We did have a handful of questions that came in. We won't have time to get to those. However, I can assure the folks that did ask questions, we will get back to you, and we will address those for you, whether it be someone on the call today or someone from a local office. Thank you for submitting the questions. We do appreciate your attention. Hey, Bill, let's start with you. Hints, tips, opportunities, suggestions that you might have for the participants this afternoon. What do you think from a personal line standpoint?
I believe none of us are victims of the market. I think that the best performing agents, the best performing cover holders, the best performing carriers are still going to do very, very well. And I think that in a market like this, it opens up the opportunity for us to bring value to our clients. And so we've got to be very communicative with our clients about what's happening in the market. And I think particularly, I believe that there's a role for the policyholder to play in the solution, and that comes through mitigation. For whatever reason, homeowners have been very reluctant to proactively mitigate their homes, installing water shutoff devices, putting the new roof on when the roof is worn out, and not waiting for the insurance company to do it for them, to do hurricane shutters, to do wildfire vents, a lot of things that are not that expensive to do. The general population has been very reluctant to do it. And I think there's an opportunity for us in the industry to educate our customers as to what's going on, help them with these mitigation strategies. They're going to make them more insurable. And that's really, I think, what our job as risk managers is to help our clients be more insurable, to get the best terms available. And a lot of that these days is going to come through these mitigation actions. So that's what I would suggest that we do.
All right. So mitigation sounds like the name of the game on the personal line side. I would think that Blaze and Rebecca, you probably don't disagree, right?
No, I agree. I think also the importance of scale and impactful relationships. I mean, there's less players, right? From a company standpoint, a wholesale standpoint, and with retailers as well. There's less players in the market, and to have an impactful and viable relationship with the right wholesalers, and for us with the right markets, is extremely important. Where your business is meaningful and where you have a relationship where the scale of business you bring in matters.
Scale and quality. you know, we have over 100 years of experience on this call here amongst the four of us. I did some quick math, and you know, the quality is important too, right? The scale, we bring good stuff to the marketplace, and hence our carrier partners provide us with that aggregate and that capacity that we can distribute on their behalf because they trust us. Rebecca?
Yeah, what comes to mind for me is we have to be so intentional and thoughtful in how we deploy the aggregate and the products that we have and how we manage our portfolios. And we are going to prioritize quality submissions. So just again, going back to the valuation of the properties or complete submissions, maybe a narrative about the exposure, what our opportunity is. There is more business coming in the door than we can possibly get to. So there, again, a prioritization in quality submissions and then the depth of the relationship. Those two things really come to mind because we are going to carefully deploy the products we have to be sure it's matching, you know, what our carriers are asking.
Well, hey, thank you. We're at time now. Appreciate all of our panelists today. Thank you for your insights and your wisdom. Thank you to our, by the way, record-breaking number of participants on today's call. We appreciate your time as well. Be on the lookout for not only links to these conversations that took place today, but our written quarterly report, which should be available about this time next week. And we appreciate your business. We appreciate the trust that you provide in us. And hey, we're here to help. Just pick up the phone, give any of us a call or anyone on your local team, and we will provide you with the outcomes that you're looking for and what you need to get through this continued challenging marketplace. So thank you, everyone, and have a happy and healthy 2024. Take care now.
Happy New Year, everyone.
Yeah.
Happy New Year.
Bye.